Risk management. What is risk management? Risk management involves identifying events that could have adverse financial consequences and taking actions to prevent and/or minimize the damages caused by those events. Risk management also includes responsibilities such as controlling the cost of key inputs and protecting against changes in interest and exchange rates through dealings in the interest rate or foreign exchange markets. In addition, risk managers try to ensure that actions designed to hedge against risk are not actually increasing risk. It is useful to begin our discussion of risk management by defining some commonly used terms that describe different risks. Some of these risks can be mitigated or managed, which is what risk management is all about. So, the first type of risk is the pure risk. The pure risk are risks that offers only possible loss. An example for this type of risk is that when a plant will be destroyed by fire or that a product liability suit will result in a large judgment against a firm. Second is the speculative risk. Speculative risk offers a chance of gain but might result in loss. Investments in new projects and marketable securities involve speculative risk. Next is the demand risk. Demand risks are associated with the demand for a firm's products or services. This type of risk is one of the most significant risks that a firm faces since sales are essential to all businesses. Next is the input risk. Input risks are associated with input costs including labor and materials. A company that uses raw materials in its manufacturing process faces the risk that the cost of raw materials will increase and that it will not be able to pass this increase on its customers. Next is the financial risk. Financial risk result from financial transactions. In a firm's plans to issue new bonds, it faces the risk that the interest rates will rise before the bonds can be brought to market. Similarly, if the firm enters into contracts with foreign customers or suppliers, it faces the risk that fluctuation in increased rates will result in unanticipated losses. Next is the property risk. The property risks are associated with destruction of productive assets. The threat of fire, floods, and riots imposes property risk on a firm. Personal risk. Personal risk results from employees' action. These risks are associated with employees' fraud or embezzlements and suit based on the charges of HR discrimination. Environmental risk. These are risks associated with polluting the environment. Public awareness in recent years, coupled with the huge cost of environmental cleanup, has increased the importance of this risk. Liability risk. These are associated with product, services, or employees' action. Examples include the very large judgment based or assessed against manufacturers and some healthcare providers, as well as the costs incurred as a result of improper actions of employees, such as driving corporate vehicles in a reckless manner. Insurable risk. These are risks that can be covered by insurance. Property, personnel, environmental, and liability risks can be transferred to insurance companies. Note that the ability to insure a risk does not necessarily mean that the risk should be insured. Indeed, a major function of risk management involves evaluating all alternatives for managing a particular risk, including self-insurance, and then choosing the optimal alternative. As a result of these risks, firms use the following process for managing them. The first one is to identify the risk that the firm faces. Here, the risk manager identifies the potential risks that the firm faces. Second is measure the potential effect on each risk. Some risks are so small as to be immaterial, whereas others have the potential for dooming the company. It is useful to segregate risk by potential effect and then focus on the most serious threats. Third is decide on how each relevant risk should be handled. In most situations, risk exposures can be reduced through one of the following techniques. Number 1 is transfer the risk to an insurance company. This is often advantageous to insure against a risk. However, insurability does not necessarily mean that the risk should be covered by insurance. In many instances, it might be better for the company to self-insure, which means bury the risk directly rather than paying another party to bear it. Transfer the function that produces risk to a third party. For an example, suppose a furniture manufacturer is concerned about potential liability arising from its ownership of a fleet of trucks used to transfer product from its manufacturing plant to various locations across the country. One way to eliminate this risk would be to contract with a trucking company to do the shipping, thus passing the risk to a third party. Purchase derivative contracts to reduce risk. Firm uses derivative to hedge risk. Reduce the probability of occurrence of an adverse event. It is possible to reduce the probability that an adverse event will occur. For example, the probability that a fire will occur can be reduced by instituting a fire prevention program, by replacing old electrical wiring, and by using fire-resistant materials in areas with greater fire potentials. Reduce the magnitude of loss associated with an adverse event. Continuing with the fire risk example, the dollar cost associated with a fire can be reduced by such actions as installing sprinkler systems, designing facilities with self-contained fire zones, and locating facilities close to a fire station. Lastly is totally avoid the activity that give rise to risk. For example, a company might discontinue a product or service line because the risks outweigh the rewards. Why might stockholders be indifferent to whether a firm reduces the volatility of its cash flows? Diversified stockholders may already be hedged against various types of risk, and reducing volatility increases firm value only if it leads to higher expected cash flows and/or a reduced WACC. Here are some of the reasons that have been suggested why it might make sense for companies to manage risk or to engage into risk management. Number 1 is its debt capacity. Reduced volatility reduces bankruptcy risk, which enables the firm to increase its debt capacity. The firms with lower operating risk can use more debt, which can lead to higher stock prices due to the interest tax savings from the deductibility of interest expense. Next is maintaining the optimal capital budget over time. By reducing the need for external equity, firms can maintain their optimal capital budget. This means that a capital budget must generally be financed with debt plus internally generated funds. By smoothing out the cash flow, risk management can alleviate this problem. Next is financial distress. Reduced volatility helps avoid financial distress costs. Financial distress is associated with having cash flows fall below expected levels. Risk management can reduce the likelihood of low cash flows and hence of financial distress. Next is comparative advantages in hedging. Managers have comparative advantage in hedging certain types of risk. Many investors cannot implement a homemade hedging program as efficiently as a company can. The first, firms generally have lower transaction costs due to larger volume of hedging activities. Second is that there is a problem of asymmetric information. Managers know more about a firm's risk exposure than outside investors. Second is that there is a problem of asymmetric information, that managers know more about the firm's risk exposure than outside investors. Managers can create more effective hedges. And third, effective risk management requires specialized skills and knowledge that firms are more likely to have. Next is the borrowing cost. This reduced volatility, reduced cost of borrowing. Firms can sometimes reduce input costs, especially the interest rate on debt, through the use of derivative instruments called swaps, and any cost reduction adds value to the firm. Tax effect. Reduced volatility reduces the higher taxes that results from fluctuation earnings. Companies with volatile earnings pay more taxes than do more stable Companies with volatile earnings pay more taxes than do more stable companies due to the treatment of tax credit and the rules of governing corporate loss carry-forwards and carrybacks. Moreover, when volatile earnings lead to bankruptcy, tax loss carry-forwards are generally lost. Therefore, our tax system encourages risk management to stabilize earnings. Next is the compensation system. Certain compensation schemes reward managers for achieving stable earnings. Many compensation systems establish floors and ceilings on bonuses, or they reward managers for meeting targets. Even if hedging does not add much value for stockholders, it still may be beneficial to managers. Though the most important aspect of risk management involves derivative securities. The next section explains derivatives, which are securities whose values are determined by market price of some other assets, to be presented by the next reporters.